Everybody joining us, welcome. If you are, for people who are like sort of joining a little bit late, or if you do have to drop off early, we will record this and send it out to anybody who registered. So you won't have to worry about missing anything. But welcome. We do these webinars probably quarterly. This one is regarding growth strategies for franchisees. So we've got a lot of great things to talk about. I will introduce myself. I'm Samantha Holt. I manage our sales operations and our team of relationship managers at ApplePie Capital. I've been here for about 8 years now, and since 2017. So started as a relationship manager and then transitioned to this role, and now I get to talk about all of this fun stuff once in a while. Travis, he's joining. You want
Yeah,
to introduce yourself?
yeah, thanks, Sam. Travis Perrine. I am the Director of Business Development at ApplePie. Spent the last 7.5 years here. Been in small business lending for the last 15 and a half. Came in right on the tail end of the last financial crisis, or the big one in 09, 010. So it was a fun time to get started in lending, but really happy to be here and happy to be in the world of franchising.
Awesome.
So I think as a starting point, just a way of introduction to Apple Pie Capital, who we are. We're hosting the webinar, obviously. For those of you who aren't familiar with us, we are 100% franchise finance focused. So we're a franchise finance company that only does franchise lending. And so that's one thing that makes us somewhat unique. Another unique characteristic is we take a brand first approach. So we only partner with or set up relationships with best in class, top tier concepts that have compelling unit level economics and a track record of getting units open and keeping them open. And at that point, we'll establish with the brands we establish relationships with, we'll tailor a unique financing program that meets the needs of the franchisees, and then dedicate a relationship manager to work with all the franchisees in the system. That individual effectively becomes an expert in the brand. So they understand the nuance of the projects, how to get them off the ground, what the cash flow cycles look like, what the expansion plans typically are, and then they're able to really roll their sleeves up and help create a plan to navigate that development schedule and growth that's needed. We are we have a lot of different unique products. We can do financing for first-time franchisees, for new unit financing. We can do expansion, acquisitions. We can lend against cash flow through our proprietary recap and grow program. So we really have financing that is available at every stage of a franchisee's development schedule. And again, you can see the recap and grow there. We'll get into that a little bit more when we talk about some of the different types of expansion that you might encounter. So setting the table now for the agenda and what we're going to talk about today. We're going to start off with, how to determine if you're ready to grow. And then what are some of the requirements needed if you decide you want to add additional units? What are some of the types of growth and options to finance that growth that you might find? Touch on the financial requirements that you may come across. Talk a little bit about the considerations that you should be thinking about at different stages in your life cycle, going from 0 units to 10 and beyond. And then things that you can think about, and how to prepare and kind of best practices and things you should try to avoid if possible. And then we'll take it home with some Q&A. And there is a chat in here, so feel free to throw your questions in there, and we will make sure to try to get to all of them when we get to the Q&A section. So that said, I'll turn it over now to Sam to start talking a little bit about how to determine if you're ready to grow.
Thanks, Travis. Um, yeah, so obviously, when you're considering growth, even when you're considering your first unit, there's a lot of things to think about. There's a lot to consider. This list is certainly not all inclusive, but it's a good start. Really, it's just about taking an honest look at whether your current business is truly ready to scale, right? So, first thing is pretty obvious, having regular customers, seeing positive trends in sales. Maybe it's not sales, maybe it's memberships. If you're a membership business, are those up month over month? If you've got good consistent foot traffic, those things all mean that your brand is resonating in the area. You're in a good location. you're starting to feel like you're not just surviving, you're actually gaining traction and starting to thrive. The next one is margins. Consistent margins are a big one. I think growth can magnify both strengths and weaknesses. So one of the things to look at is there a lot of fluctuation month over month with things that should be relatively consistent, such as labor, cost of goods, etc. Is that predictable month over month? And if not, maybe taking a closer look at that first is a good idea, just to see what you can tweak and where that fluctuation is coming from, because there's a lot of uncertainty and unpredictability in growing. So whatever you can control, you want to start there. Um, the next is operations, right? How are your operations? Are things running smoothly? If your team is getting along great and you feel like you've got your staffing in place, that's a great thing. But if you're constantly putting out fires, your phone's ringing day after day, and you sort of feel like you're still babysitting things a little bit, and they're not yet running like a well-oiled machine with just that one unit, maybe you're not in a better position to take on more units. So that's one thing that's a big consideration. We also look at market demand. Is there room for more locations or services, whatever business you're in? Is there a lot of competition in the area? Do you find people asking for you or your business in other areas? This in franchising, this one is a little easier because I think, the brand's going to help a lot with this. If it's a good brand that you've chosen, they're going to help you grow smartly and they're going to handle a lot of that demand factor, but you still have to keep a pulse on it yourself. Otherwise, you're not, playing your part. And finally, one of the clearest signs is simply being too busy. Maybe you're turning customers away or your team is stretched too thin. That kind of pressure is a good thing. It can be a strong cue that it's time to grow. All right, so if you're checking all these boxes, what do you do next? Um, this is the fun part. You get to create a financial strategy. There's a lot of ways to do this, but just kind of high level, identify your goals. This could be obvious, but you have to begin with the end in mind. The strategy for someone who wants to grow 1 to 3 units is sort of your max, and that's where you think you want to end up. That's great. Your strategy is going to look a lot different than someone who wants to have 10, 20, 30 units, right? It's just a completely different short and long-term plan. So you want to consider timing when it comes to this. You want to consider if you have a development agreement. Is it aggressive? Do you need to be planning for multiple units opening at once? Or do you think you'll have the flexibility to sort of work through these one at a time based on where you want to be in 5 years or 10 years? The next thing is financial statements. It's pretty simple. Just prepare your current financial statements, both personal and business. Have your financials ready and organized to share with lenders and any other stakeholders, whether it's partners or franchisors or whatever the case may be. Just make it easy on yourself and have them ready and organized at all times. Um, Cash flow. Forecast your cash flow. This is something that uh, you're sort of required to do when it comes to financing, but some people can get away from it as they start to add more units. You start to maybe manage out of your bank account, things like that. But being diligent in this is really going to help you be prepared to grow. Be realistic when you're doing it. So make sure that you're considering additional layers of staffing, depending on the number of units you're planning on in the short term, and make sure that those costs are considered in your forecast. You might have older units. Maybe the first unit is one that you acquired. Maybe it was a little bit older and you've got remodels or upgrade costs sort of right off the bat. So those are things to consider when you're forecasting your cash flow. Next is strategize with the professional. I mean, this can be a lot of people. This can be lenders, focus on building relationships with your lenders. When speaking with them, make sure you're considering more than just the rate and term they're offering. Are they interested in discussing your growth plan? Do they seem to have a path forward in mind, or are they sort of transactional in nature and just talking about this one unit that you're looking at? Um, Other seasoned franchisees, those are professionals too. Don't be afraid to find a mentor or someone in your area who has a lot more experience than you and can help guide you and kind of share their war stories and what to do and what not to do. Infrastructure, we're going to talk about this a lot, I think. Aside from just the cost of adding additional employees, building your team up, that takes time and effort and a lot of thought. Some of the most successful franchisees are making this one of their top priorities on a daily basis, right? So just figuring out how you want your organization to run, what your values are, and what's going to make you efficient. Identify the people who you already have on your team who they're going to help get you where you're going, put incentives in place and systems in place to make it possible for your business to run when you're not physically there, because one unit's a lot different than 5 units, and you can't be in 5 places at once. Um, Review your results. I think a lot of people in just goals in general, I'm guilty of this. Like you set goals, you accomplish them, and then you kind of move on. But I think revisiting your plan regularly is important because things are going to change. So once you hit certain milestones, take a look back and sort of look at what worked well, what you could have done better, things like that. All right, moving on. More questions to ask yourself. There's a lot of questions. There's a lot of self-reflection that goes on in this process. Um, you know, I think after considering all the things we just talked about, the obvious one is, do you have the financial capacity to grow in the next 1 to 3 years? Growth takes money, right? And often more than we think. So make sure you're considering new leases, staff, equipment. You just need to know what you can realistically support. Operationally, we talked about this a lot. Ask questions like, if I added 2 units tomorrow, could my current systems handle it? Do I have the right managers, processes, support in place? Just diving more into some of the things we already talked about, that's important. Location. Is the territory in your current brand or your current location, is it close enough to where you want to be? Staying close makes growth a little bit more manageable, but if that's not an option, maybe it's time to think about other brands that complement what you're already doing, or adding partners that can be where you need to grow. If where the demand is not where you physically are, then those are things you have to consider. Should you consider branching out and diversifying? Some franchisees can really benefit from owning multiple brands. Um, there's a lot to think about there, right? But it can be a good thing, especially if it helps you reach new customer segments or balance seasonality. A lot of people do it for that reason. It's not for everybody, but just ask yourself that question and think about how it fits with your strengths and with your goals. Something else to think about is how you stack up against other franchisees in your area or that are similar in size. So, how do your sales compare to theirs? Are they growing? What are they doing differently? Sometimes the best insights come from just simply looking within your system. And then, what's your end goal? Are you building to sell someday? Are you hoping to pass the business on? What's your exit or succession plan? That should, when we say begin with the end in mind, that should, what your end goal is should influence the choices you make every day, right? So just sort of always thinking long term. All right. You thought we were done with questions, but we're not. We've got one more slide of questions. Um, More what ifs. Now that you've sort of looked at whether you're ready for growth, ask yourself some of the key questions. Play out some more scenarios, right? What if you had the chance to double in size by acquiring more units versus just growing one by one? That can be a great way to do it, but what does that mean for your leadership bandwidth, your systems, your capital? We talked about brands already. What if you were able to diversify into another brand? What does that look like? What if you have 2 units and they need to be open within weeks of each other? That can happen, right? Sometimes the right location comes along and but the timing's not great. So what would that look like? What would your plan be and how would you handle that? Um, what if you get to a point where you have distressed units or things aren't going so well, but you maybe have already committed to some growth? So uh, there's a cash flow drain, but you've got a lease that they're signed. How would you manage that? What do you have in place to get you through that time? What if things are starting to consume your excess cash flow and you just don't have as much flexibility as you had before? How would you weather that storm? And just generally thinking, how would any of these scenarios affect your current operations? So growth is great, but it needs to be aligned with your capacity and your long-term vision. So after all this analysis, what are different ways you can accomplish growth? Travis is going to share some of those with us.
Yeah, so thanks, Sam. So you've asked yourself a billion questions, it seems, and you've come to the determination that you'd like to grow. Growth can come in a number of different ways. Organic growth really is white space or green space development. You know, you're adding new units by developing them from the ground up, and you know this comes with an advantage of the ability to be able to to curate the location, to be able to pick your staffing, to tailor your marketing plan from day one, to really be the first person or group to have that impact or that influence in the community. So you're sort of setting your first impression. You have that luxury of being the first impression in the market. The flip side or the converse of that is, there's distractions to your existing operation with developing this way. The impact of those distractions probably is more severe for a smaller group, maybe somebody who's got one or two units looking to expand from there versus an organization that might have 15 or 20 units where they've sort of got that well-oiled machine. They've got a big back office. They've got all the staffing in place for that development where it's not really disrupting the existing operation in any capacity. But if you're a smaller group, sort of growing grassroots organically, it's going to take time to do the site selection, to go through the lease negotiation, to curate a general contractor, go through the bid process, get through the permitting process, staffing, making sure you got the right people in place to open your doors, making sure you got the right marketing, grand opening and marketing plan in place. And then just the time and attention that additional that takes to get the business off the ground when you do open your doors. So all of those things can be a distraction and can potentially impair or inhibit the existing operations you have in some capacity. So you want to be able to account for that. Always be thinking of that if you're going to grow in this fashion. Additionally, growing this way can become a challenge from a financing perspective in some circumstances. Typically lenders are going to evaluate the existing units you have and how those are performing over time. And they're going to use that as part of the rationale of whether they feel like you're ready to grow. If you're in a business or a brand that takes a while to ramp up, and you're trying to accelerate a fast development schedule, that can be tricky. Doesn't mean that you're in a bad brand. A lot of the best brands in the world take 2 years plus to get to really stabilization. But once they get there, they're extremely profitable. But if you're trying to grow while you're in that ramping period, a lot of lenders may look at you and say, "Hey, we want to see more time. We want to see you get, season the cash flow, get the performance up a little bit more before we really truly have confidence that you're ready to expand." Another way to grow is through acquisition. Very popular way to grow. You're buying cash flow, you're buying an operating business. Um, the kind of thinking about the same couple of bullet points from the prior slide. You don't have the luxury of cultivating that impression in the market, right? You're inheriting whatever the prior ownership did, good or bad or ugly. But hopefully it's good, right? If you're buying a business that's profitable, they probably are doing something right. Some things you want to consider there, if you're going to go this route, is operational infrastructure. Sam touched on this in some of the questions to ask yourself, but it's a very different operation being a 1 or 2 unit operator versus being a 5 unit operator, or 10 unit operator. You're an owner operator in a lot of ways when you're in your first unit or a couple of units. But as you expand from there, Sam mentioned you can't be everywhere at once. Your role changes, and you need to make sure that you have the bench in place to expand. Do you have the right team in place to accelerate to managers and eventually district manager, area managers? All of those things are going to be necessary in order to expand, even through acquisition. Um, and then additionally, there's other back office functions that you need to be thinking through, whether it be accounting, marketing, in-house marketing, some things that are going to change or evolve over time, including your role, of course, as the owner. Um, Staffing impact. You're inheriting an existing staff. That can play out a number of different ways. They may love the current ownership. They may hate the current ownership. You may like some of the staff and not love some of the other staff. You may have people in your organization that you want to progress and promote into roles in these new stores. There's impacts to all of that, right? You're kind of upsetting the apple cart in a lot of ways. And that can have a short or a medium term, sometimes even a long term effect on the performance of the unit, and the culture that's in the business itself. So you always want to be cognizant of that. It's a tricky thing to do when you're going through the purchase negotiations and process, because a lot of times the current ownership doesn't want to really alert their staffing to the change of ownership until it's really close to the finish line. So you might have an opportunity to see them in action, kind of secret shop them, if you will, and do some things like that and kind of get a feel for who they are. But a lot of times you're not going to really know everything you want to know until you're on the other side of the transaction. So always want to be cognizant of that. Lease and landlord considerations. This is a big one. You're not always inheriting the same lease terms that the current ownership has. That could be in the form of a change in the rent expense. It could be in the form of change of some of the other relevant terms in the lease. I always recommend engaging an expert here, whether it's a lease attorney or some sort of a broker lease experts that really understand the nuances of a lease. We're not attorneys in most cases, so it's good to engage people that have that legal background and understanding. And then if there is a lease expense change, an increase in the lease expense, you need to factor that into your evaluation, because you're looking at historic cash flow with a certain fixed cost for occupancy. If that's going up, that's going to affect your future earnings, all other things being equal. So that's a consideration that you should factor into, what you're willing to pay for the business you're buying if it is a change. Condition of the location is important. You could have, aged equipment, depreciated equipment. You could have, deteriorated, business, fixtures, furniture, all that kind of stuff could be aged out and needing to be refurbished or replaced. Brands oftentimes have mandated refreshes and remodels. If there's any of that in the immediate time horizon or near term time horizon, there's a cost associated with that needs to be factored in. So, are you going to include those expenses into the financing or try to do it that way? Or is that some sort of negotiation that you're going to have with the current owner in terms of whose responsibility is it to carry those expenses? Does that mean a reduction in the price of the location, for instance? And then finally, sales trends, I think, is a really important thing to look at. If you want to always explore the financials of the business going back several years, so that you can see the trend the business is on. The current year might look great in a vacuum, but if you look at it and it's down 20% from the prior year and down 20% from the year before that, there's a concern there, not only from someone like us as a lender, but you should be concerned as well, because the reality is you don't know where the bottom of that is, and it may not have hit bottom yet. So you may be buying something that is going to dramatically change no matter what you do year over year, and become a drastically different business than what you thought you were buying. So it's important to understand, if you see that trend, what's going on. Is it a change in the demographic or the market? Is there issues at the brand level, for instance? Or is it just simply the current owner sort of taking their eye off the ball? They've been in the business for 15 years. They're burnout, they're stale. They just sort of stopped caring, if you will. But all important things to consider, and also should be factored into the negotiation of the purchase itself. So now you've decided you want to go ahead and acquire a unit or units. What are your options for financing? So these are just a few of the most common ones. I will say any of these can be used together in conjunction with one another, or independent of one another. When you look at like seller financing and cash, if those are going to be standalone or maybe together, but not in conjunction with any financing, any traditional financing, I'd say the most common scenario there is you're probably buying a distressed asset. they're very difficult to finance if they don't have positive cash flow. Sometimes the only way to take that unit over would be to pay cash or enter into financing with the seller themselves. Doesn't mean that that can't be a good strategy if you're a strong operator in the system and this is a unit that you can see some great value. You kind of recast their financials, see some areas where you know that you can immediately make improvement and you can buy this for pennies on the dollar, and it's in the right geography. It could be a great decision. Just be aware if you're buying negative cash flow, that's going to be your negative cash flow until you are able to turn it around, which could affect future financing down the road. Otherwise, if you're looking at financing through lending, you could, roll the equity from an existing business that you have, franchise location or locations, and use that equity to purchase. That's really is our recap and grow program in a nutshell. It's a ability to borrow against a multiple of your EBITDA, and then use that cash. You could effectively purchase the unit that way. Or you could just go for purchase financing, traditional financing for the acquisition, where the lender is basing it on the historic profitability or seller discretionary earnings of the business that you're buying. And again, all of these could be combined or mixed and matched as a part of your financing strategy. All right, some things to consider. What kind of lenders' requirements or things that we're going to be looking at when we're evaluating a loan application for expansion. Equity into the project. SBA can go as low as 10%. Doesn't mean they're going to always do that, but they have the ability to do that through the program's requirements. For a short period of time, you could do no injection for expansion SBA. That went away this past June when they reinstated the 10% rule. Typically, conventional lenders are going to want a little more skin in the game. So 20 to 25% you might see. We can go down as low as 15 in our product, but I'd say, in general, you're going to see a little bit larger injection requirements on conventional versus SBA, absent, of course, of borrowing against the cash flow of the unit, like our recap product where there's no injection there. Liquidity is important. Just because you're buying a business, a lot of people assume I'm buying cash flow. I don't really need liquidity. I'm going to have some working capital built into it. What do I need to have reserves for? Lenders like reserves. You should like reserves as well. That's stability. There's always a million things that can happen that are unforeseen that might cause delays in your project, delays in your time to break even, delays in getting to the cash flow level that you ultimately expect to get to, personal issues that can pop up. Some things that could happen to your existing business, maybe a construction project takes place in front of your storefront that impedes your entry and causes a short-term issue with your cash flow in your existing unit. There's a million things that can happen that you need to have a reserve ready to throw at. So that cushion is super important to us. And as you're looking to grow, it should be a big importance to you as well. Make sure you're well heeled and capitalized enough for the expansion itself. Existing unit performance is extremely important. Lenders are really going to look at, how does the profitability of your existing businesses relate to your debt payments? The ratio, we call it debt service coverage ratio, but essentially it's a measurement of how many dollars of profit a business has for every dollar of debt payment that they make. Every lender's got different ratio requirements there. I'd say 1.25 is probably the most standard, but you'll see banks that have higher thresholds or lower thresholds than that. But if you're underwater, if you've got larger debt payments than your profit, that's probably going to be perceived as an issue and certainly going to impair your ability to grow through financing at least. And then leverage. This is really just a measurement of the amount of debt you have versus your EBITDA, your store level profits. Banks want to make sure you're not biting too much off too quickly. They want to make sure that your debt is sized appropriately with your business. Just like debt service coverage ratio, that appropriate ratio there can vary from bank to bank or lender to lender. I'd say a lot of banks sit in the 3 to 3.5 leverage point there for comfortability. We'll go up to 4.5. There are some more aggressive banks that will even go higher than that. But really, that's just a test that says you're not over leveraged, not maxed out on your credit to a point where taking on more debt would be a potential risk inherent in expansion. So that said, we'll turn it back over to Sam now. She's going to talk a little bit about the specific nuance and pitfalls and challenges as you go through your life cycle from the ground up to being a multi-unit operator.
Thanks, Travis. So yeah, those are we broke down the requirements in a little bit more detail, and that can be kind of overwhelming just depending on where you're at in the process. But obviously, um, what works best for you is going to change a lot when you're at 1 unit versus when you're at 5 and above. So we're going to talk about that a little bit. Um, the first unit is relatively the easiest to get financing for all things considered, but it can be overwhelming because you just don't know what you don't know. A business loan is very different from other financing that the average person is used to applying for. I don't know how many first-time franchisees are on the call, but I think it's worth talking about because some of the considerations still apply further down the road. One thing people tend to default to at any point when they start to get frustrated with the loan process or they just aren't used to seeing some of the terms, maybe rates are higher than they like, or is it, and they just think, well, I'll just use cash, right? Like I'll use my cash or personal assets. That's easier. I just want to get this done. Um, and so, this can be an option. There's room for that. But especially on unit number one, there tends to be less pros and more cons on this approach. The first reason being is that if your ultimate goal is to have multiple units, you want to preserve your liquidity for as long as you can, right? This is going to be your lifeline when it comes to anything unexpected, whether it's cost overruns, maybe the unit's taking longer to break even, you need extra working capital, whatever the case is. Cash just gives you a safety net. It gives you flexibility during any periods of uncertainty, and it's something that you want to hold on to if you can. Um, the other consideration is on units two and beyond, the lenders, like Travis talked about, they're going to be focusing heavily on your existing units, whether that's 1 unit or five. They're going to want to see how long it's been open, what does the cash flow look like? And given, that it takes a little bit of time to ramp each business, there could be a period of time where it's too early for the lenders. Maybe it's just your first one's only been open 6 months. Or maybe you have a lot of them open, but they're all relatively new, right? You did 2 or 3 at the same time, and it's to the point where it's just too soon, or they are giving you the impression that you're growing too fast. Um, in some cases, you might want to listen to the lender, but in other cases, if you're confident in your strategy and you're ready to grow and open unit 4 or 5 or whatever that is, um, having strong liquidity in that situation either helps banks get more comfortable or it gives you the chance to pay cash for that unit if that's what makes the most sense for you at the time and you don't want to pass up that opportunity. Um, so on the first one, there's plenty of ways to get it open. We talked about cash, talked a little bit about SBA loans and core loans. Those are great options on for core loans through ApplePie for eligible brands. We can do that for first-time franchisees. SBA loans are always going to be an excellent option. There's something called a 401k rollover. It's otherwise known as ROBS, rollover for business startup. Um, People do that. You can use your former employer. You have to not be at that job anymore is one of the caveats. Um, and there's a lot of complexity to that in some ways. So I'm not an expert and won't speak to that, but there's a lot of great companies that facilitate that if that's something that you want to do, if you've got a large amount of money in retirement and want to start making that money work for you earlier on, that's a great way to do it. Securities backed line of credit. Uh, some people do consider this can be something it's still sort of a form of personal financing, but you're not taking all of that cash out at once. It's there's pros and cons, right? You can leverage your assets without actually selling your investments. It's a less expensive option, comes with some possible tax advantages, but the biggest risk is going to be obviously market fluctuations and any uncertainty there. So you'd want to make that a major consideration if you were looking at that option. So moving on to some emerging franchisees, I'm guessing this might be where a lot of the folks on the call fall into that 2 to 5 unit spot. This is a tricky spot, I think. At this stage, there's just more variables at play, right? If you're performing well, you might be presented with a lot of options to get your next unit open. And so this is a good time to sort of go back to your original plan, go back to all those key questions that you should ask yourself that we talked about earlier, And if the answer is yes to a lot of those questions, things are running smoothly, cash flow is consistent, and you're in a good cash position, then continuing to grow is going to be a lot easier. However, I think in this stage, it can be easy to get caught up on cheap capital during this time. Or sort of like taking like those short-term loans. A lot of people sort of fall into that, whether it's because things are going well and you're looking at term sheets from lenders with an incredibly low interest rate, low fees, everything looks great. It's a lot better than what you saw in unit number one, so you kind of get sucked into that, and you want to jump on those. In the moment, it seems like a no-brainer, and maybe it is, but you just want to dig into the fine print, really understand what's being required. Are there covenants? Are there prepayment penalties? Does it align with your long-term growth plan? Things like that. So just make sure you're kind of reading into everything beyond rate and term when you are at this stage and you start becoming a lot more attractive to lenders. On the flip side, this could be where you end up with a unit or two that's struggling, right? Maybe things aren't all sunshine and roses at this point in the life cycle. And that's where it can be tempting to take on more risky financing. You're in a cash crunch, and there's merchant cash advances or short-term high interest debt that can be sort of tempting to get you through the next month or the next payroll cycle. But for a lot of people, it ends up being just this thing that you're chasing, and so those are things to just be careful of when you get to this spot and figure out what it is that's causing that and fix those things before you start to grow into additional units. Um, at 2 to 5 units, options are still primarily SBA and Core, our ApplePie Core product. You may see conventional financing at this stage, but generally it doesn't start until you're at that 5 unit mark. I think depending on the brand, you might see it a little bit sooner, but we talked about the limitations of SBA. We talked about the core loan a little bit. These are both really good options depending on where you're at in that 2 to 5 space. A lot of it depends on just your personal liquidity picture, whether you're doing acquisitions versus new units. Those are going to be your main financing options, though, in this stage. Once you get to be, 5 units and beyond, that's when things are generally a little bit easier, you hope, right? When you get to this spot, using equity in your existing business can really be one of the best ways to expand. You're to the point where you can really leverage the cash flow and all of the equity you have built up over time, right? Conventional lenders will do this through a development line of credit. These can be a great option, as they usually come with low rates, minimal fees. The problem is they do tend to come with lower flexibility. So for some people, that's okay. Like I said, it depends on your growth plan and where you want to end up. But there are reporting covenants to consider. How restrictive are those? They can cause problems when there are shifts in your profitability, right? So if I know we can't all predict that, but that's just something to consider. It just puts a little bit more handcuffs on you if that comes into play. They also come with prepayment penalties most of the time, so that's definitely something you want to map out. Just understand how that will affect your plans a few years down the road. But I think the main takeaway is that you can start growing with little or no cash out of your pocket once you get to this point in your growth. Um, Talked about conventional just now. ApplePie Core Loan is, again, a really good option for this spot. The Recap and Grow product gives you cash out for either new development, refresh or remodels, or acquisitions. So depending on your cash flow, you can finance 100% of your project, which is great. This can help if you're developing or purchasing multiple units at once is one thing to think about. This is something that makes it a lot easier and more flexible. We can do that by just leveraging 1 unit or maybe 1 or 2 units, depending on your cash flow, but we don't have to encumber all of your locations in order to accomplish this, which is something important to think about. It leaves you more flexibility, and just allows you to grow a little bit more aggressively at this stage in the game. Once you're at this point, the SBA is definitely still out there, and I won't say it's not an option. It can still be a good option for certain things, but it's just given the other loans you'd likely have access to, it's generally not going to make the most sense if you are in a good spot, right? If you're not struggling, if things are looking strong, SBA is just gonna not it's not gonna have as much flexibility, and it's going to be a lot more paperwork. The more units you have, the more requirements there's going to be, and so that's going to make it a little bit slower, is the best word to use, I think. This next slide is just a side-by-side comparison that shows a lot of what we already went through. Um, Travis, you're great at rattling off these pros and cons. What did I miss in the last
I
couple?
mean, I think it's the chart's kind of self-explanatory. I think the important thing to note here is there's no silver bullet in financing. What option will make the most sense is going to depend on a million different factors. Probably most importantly, where you are in your life cycle or your development, like Sam just illustrated. But also what's important to you from the structure you're financing. SBA loans and the ApplePie core loan are going to offer 10-year terms. SBA can go longer for real estate transactions. Conventional lending's probably capping at 5 or 7 years. Again, prepayment penalties can be restrictive. So there's pros and cons to every single option. I think what's important is understanding the differences, what really comes with each option beyond just the rate and fees. I think that's a lot of people get caught on that, and that's important. Obviously, the cost of financing is extremely important, but the structure of the loan is also very important because you've got to make sure that you're going to be in financing that's going to help you grow, and it's not going to impede your growth by putting strain on your debt service ratios or inability to refinance if need be, things of that nature. So, I think the underlying importance is just to find a group, whether it's us or somebody else that you really trust, that can help guide you through that and give you good consultative advice on how to navigate the right options at the right times.
Yeah, agree on all counts. Um, we talked about remodels and reimages. We mentioned them a lot, but we didn't really go into the best way to finance those. I think there's a few different ways that you can do that. We've got there's a lot of equipment lenders out there. We have a division at ApplePie for equipment finance loans, so you can do that as standalone transactions. Oftentimes, they're pretty quick and easy compared to all the other options we talked about. Just smaller loan sizes, quicker time to approval, and generally a little bit shorter term than some of the longer term financing that we talk about. Um, but it's also good to not to just obviously have these in your, revisit your plan annually and see, do I have remodels coming up? Do I have mandatory refreshes or things like that that I have to account for? And you can just lump them into your other loans, right? If you're doing a refinance or a recap for growth, but you have other needs at that time, it's probably a good idea to just lump those in there if there's room, because you sort of kill two birds with one stone. You get a little bit longer term than you would with the standalone financing. So if the timing's right, it can be a really good way to account for those. Um, and also like just if you're at a working capital shortage, you can also sort of to a certain extent can include that into some of those global refinancing and recap options versus doing the alternative and taking another short-term loan, like we talked about some of those riskier loans. You can kind of strategize this a little bit differently and maybe add in some short-term working capital into that middle bullet point right there.
Yeah, and
Any
I would just add, this should be always be on top of mind when you're thinking about growth, because every brand, I've yet to see a brand in franchising that doesn't do remodels and refreshes at some juncture in their development. And a lot of the legacy brands have done, multiple of them that, if you're a long-standing franchisee, you've been through many of those. And they all cost money. So, you've got to be aware of when those are coming up and factor that into your financing plan and be aware of the expense that's going to be there. And to Sam's point, that might be a situation where you incorporate that in another financing project you're doing, sort of, to her point, kill two birds with one stone, or the standalone financing options that are out there. You might pay cash if you've got really good liquid reserves handy, but you want to be able to be aware of that. That's a cost that will come up, and brands can penalize you if you don't do them. And you don't want to get into that situation where you're in violation of your franchise agreement because that can cause a myriad of other problems. So be
Yeah,
aware, be
sure.
thinking about it.
Be aware. Um, this is sort of a summary. I think it encompasses a lot of the stuff we already talked about. But I think it just speaks to the preparation of um, always always sort of having your finances buttoned up. Um, Lenders have they when people are prepared, it makes their job easier, right? They want to have good visibility. They want to be able to understand your financials. Um, and so try to simplify those, work with your CPA on that. I know there's a lot of creative things that people like to do when it comes to tax strategies, and nobody likes paying taxes. But think about your long-term plan when you are preparing these month over month or your annual financials, and try it, for example, if your goal is to sell, if that's part of your plan, you're going to sell units in order to buy more. You want to be able to sell at a high multiple. You want to be able to get as much as you can for your business. And if you've historically ran all your personal expenses through your business, that's going to make it hard, right? So it's sort of a short-term gain. Maybe you paid a little bit less in taxes, but the amount of money you're going to get when you sell that business is going to really outweigh any of those benefits if you've ran your if things are clean, right? If your profit and loss statements are consistent and they're clean and they're easy to understand, it's going to cause less problems in the financing scheme. It's going to be less questions from underwriting, and it's just going to allow a little bit smoother process for you on all of those fronts.
All right, so I think we're good to open up Q&A. I don't see any questions in there yet, but we can take them now if anybody has questions asked. Judah, do we open up the Q&A chat? I don't see. I just see the
It should
internal
have
one.
been it should have been enabled.
Oh, okay, I see it. Yeah, Q&A. All right, no open questions. All right, we'll give it a couple minutes, and then if there's no questions, I guess we must have done a great job explaining everything. And
Travis and I are both really fast talkers, so I don't know. Hopefully, you guys took good notes.
yeah.
We both tend to speak a little quickly. Um, but I think for those that missed at the beginning of the call, just so you know, if you did join late or have to drop off a little early, we will send out the recording, usually in a day or two, to everybody who registered. So you will all have that to reference if you want to give it a listen. And I appreciate everybody
All right,
joining.
we do have one question. The question is, are any new changes to SBA with the new admin to help us? I mean, there was a lot of changes. I think this is pretty common when you see a new administration, especially when you're switching parties. The new party or new administration kind of wants to undo everything the prior administration did and vice versa. I think the SBA lenders, by and large, there was one thing they were pretty happy about was the previous kind of administration had this policy that says just do what you do, which kind of meant, just kind of act as you always have acted and we'll be cool. And that was very vague and kind of it led to a lot of inconsistency in the program and misinterpretations of the SBA's rules. So the new administration came back and they kind of reinstated a lot of rules. A lot of those I think are probably would be more borrower facing challenging. For instance, they reinstated the guarantee fee to all loan sizes where that had been waived for loans up to $1 million. So that sort of brings SBA fees back up to what they were pre-pandemic. Because for the last, 4 or 5 years prior, the guarantee fee was being waived. They also restricted foreign ownership, which means if you have a business that has even 1% ownership of a non-US citizen, non-green card holder, it's now ineligible for SBA financing. So a lot of changes. I think overall the program, stayed pretty similar. The injection again came back to 10%. I think the biggest advantage that you as a borrower would see is just more consistency because I think the rules are now defined better than they were, and that'll allow you to have a little more consistency from bank to bank and a little less uncertainty.
Yeah.
Um,
I
All
think
right.
bring back the franchise directory too, help.
Yeah, that was helpful too. The franchise directory, for those who aren't familiar, that was the SBA would publish a directory of all brands that are eligible for SBA financing because not all franchise brands are. For instance, if you're in a salon brand like a a Sola Salon or My Salon Suites, those are not SBA eligible brands. The driver typically is, does this brand or business create jobs? Because the SBA program was created decades ago as a job growth vehicle. So if if it's a business that doesn't, it's isn't perceived to create jobs, then it's likely not going to be SEO eligible. And so when the directory went away, that created sort of a lot of uncertainty of whether a newer brand was eligible for financing or not, and that caused some issues. So yeah, good call out, Sam. That's definitely right.
Yep.
All right, next question. Do you have any tools or spreadsheets to project cash flow? So you want to take that one, Sam?
Yeah, I think well, we I think I would start with the brand on this. I think most brands will give you something, a forecasting tool, and that's something that's good to share with the bank. But what I would also say is that the bank that you're working with, I think you can lean on them for, you know, for some advice on that. It's difficult as lenders; we can't influence that a lot. But I think just having just a good format is a good place to start. I would start with the brand or maybe even other franchisees there, and then being super realistic about your what you're putting in there and making sure you're accounting for everything is the most important. But the format part is probably relatively easy um, as a starting point.
Yeah, and to Sam's point, the brand's always a good starting point because everybody's cash flow expect or their how they model cash flow and brands, membership based businesses, for instance, versus kind of a retail type business, very different types of expenses and revenue streams. So you want to make sure that you've got the right format to match the type of business that you're running.
Yeah.
All right, next question. Can you talk about sales and EBITDA expectations to qualify for conventional loans? Um, every brand's got expectations. A lot of lenders will look at the item 19 as a starting point or a baseline, and some brands publish a lot of detail in their item 19. Other brands publish nothing in their item 19, and some of the largest, most established legacy brands publish absolutely nothing. But there's other ways to find data on what's sort of expected and what's normal, I guess. I think it's really relative. To be honest, though, it's relative to the amount of debt you have and to, the size of the projects, how much you're needing to finance to open a new location. Again, the two ratios, the two most common ratios, basic ratios that lenders are going to use are debt service coverage ratio and debt to EBITDA. You'll see some get into like fixed cost coverage ratio and some other calculations that get a little more complicated for conventional. But debt service coverage ratio, like I talked about before, is really a measurement of how many times your EBITDA is going to cover your loan payments. So if you have $100,000 in annual loan payments, 8,250, whatever that is a month, and you have 150,000 in profit, then your debt service coverage ratio is 1.5. That's probably going to be a comfortable number for almost anybody in the lending community. A lot of lenders will go a little thinner than that even.
Mhm.
But it's all relative to the situation. If you've got a pretty nice debt service coverage ratio, but you're looking to add two additional units, going from 1 to 3 over you're probably going to have some personal strength to bring to the table to overcome sort of the rapid growth. So there's a lot of factors that play in that.
Yep.
Sam, anything to add?
No, I think you covered it great. And looks like the same person has a question about local community banks like comparing those to large mega banks, which is preferred. Um, yeah, I mean, I think that aside from the size of the bank, I think the best thing to do is to focus on if you're in franchise, which I'm assuming you are on lenders that specify in franchising. Because even community banks, they are a lot more, they're easier to work with and they're a lot more willing to lend to small businesses. But if they don't understand the franchise business model or your specific brand, then you're starting with an uphill battle. So it's not to say you can't start there, but I think finding lenders that in the franchise community that specialize in that business model is probably the more important factor. Large mega banks, they don't. I don't know that they're a great fit for most franchising unless you're in a brand with thousands of units open, or when you're a larger franchisee, then maybe they make sense. But for anyone who's 0 to 10, 0 to 20 even units, it's not the best fit. And they're looking for usually higher loan amounts, generally speaking, and it's just hasn't been the best fit overall, I feel like.
Yeah, just to add on that, I mean, I came from JP Morgan Chase, which is the largest mega bank in the entire country, and did commercial lending for them for 7 years almost. And we didn't touch franchise, and they really don't still touch franchise. Bank of America's a little bit into the franchise space, but mostly conventionally. They don't like to really do SBA. Wells Fargo, they'll do some SBA. They have a national franchise. They're probably the most franchise friendly of the large banks. But your best bet, to Sam's point, really is just focusing on a bank that knows franchising and understands franchise lending, because it's a nuanced type of small business lending. It's different than just general small business. And if you're going to a local bank, or a small bank, community bank, you're probably going to go through the SBA program, which is fine. The problem is that bank, you're going to be working with a local banker that you might be their second SBA loan they've ever done in their career. And if that's the case, you're going to run into, beyond them not understanding the model or the brand or what you're doing, the SBA process is a beast. It's a lot of work for the bank. And anybody who's gone through the SBA process knows it's a lot of work for the borrower too. But it's a very delicate process that needs a very expert team. And even those of you who had bad experiences, they still probably understood the process a lot better than a local bank would, in that case. So I would be cautious about the local bank option. I've seen that blow up in people's face a lot of times.
Yep.
All right, the next one, is it better to pay more on your first loan to get the total amount of the loan down, or not pay additional amount on loan and have cash available when applying second loan, or does it matter? Go ahead, Sam.
Yeah, this one, great question. I think generally speaking, it's better to save your cash, right? I think that if on your first loan, if you're easily able to cover your debt payments, your cash flow is going to work better for you when you're putting it into your second unit versus paying down that loan aggressively. I think let the business pay the note if it's covering it comfortably, and focus on, because we're talking about growth, right? If growth is your goal, putting that money toward the loan is going to save you a little bit on interest, but it's not going to help you get your second unit open quicker. So I think that that's different for everybody, but the time to start worrying about that is when you're closer to reaching your growth goals, and then you're focused on paying down debt. I don't know that that's most people's focus in like those early years.
Yep.
Correct me if I'm
100%.
wrong.
No, 100% agree. I think if you're still in your development schedule and you're still in growth mode, cash will keep you nimble. There's a number of ways to grow, like we talked about. It could be building out new units, it could be acquiring a unit. Acquisitions kind of fall in your lap sometimes. Perfect real estate falls in your lap sometimes. Having cash at hand is how you're nimble enough to execute on those opportunities when they come around. And if you focus on extinguishing debt or driving debt down, it can seem like an attractive option at the time, but it's really likely just going to impair your growth a little bit. There's a point in time where it makes sense, and that's when you get to that stabilization point.
Yep.
And you're maybe taking a beat. You're going to pause for a couple of years before you develop more. Then it might make sense to look at restructuring all your loans, doing like a global refi, with possibly like a pay down even, or something of that nature. It's restructuring it for quicker payoff and lower rates.
Yeah, definitely. There was one last question, but I answered that in the chat. It was about debt service coverage, so I think we got all of our Q&A questions answered right at 1 o'clock on the dot.
Yeah. Well, thanks everybody for who attended. I hope this was a useful session for everybody. We always enjoy doing these. So we'd love to have you guys back for the next one, and tell anybody else you think that our content would be useful, and hope everybody has a wonderful rest of the summer, and hope your businesses thrive.
Yeah, thanks for joining, everybody.